First Solar agreed to pay $350 million to its investors for inflating its stock price by concealing defects and reporting misleading financials. Shareholders sued over 6 price declines in First Solar stock from 2008 to 2012. The stock declined 89%. The lawsuit was finally settled in 2019, so it affects their 2019 financials. Let's look into the company a little deeper to figure out if the stock is a buy or a sell. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day to 8 a.m. In this video, I am going to walk you through the process of valuing First Solar stock by analyzing their financial ratios and dissecting their financial statements so we can determine if the stock is a buy or a sell. First Solar designs, manufactures, and sells PV solar modules. It also provides operations and maintenance services to system owners. First Solar is one of the world's largest PV solar module manufacturers. Let's get started with the model. This is a mid-cap company, 9.9 billion market cap. They're trading at $93.31 a share. To get shares outstanding, its market cap divided by stock price gives us shares outstanding 106 million. Let's look at the financials. Free cash flow is how you value a company. You estimate the future free cash flows and then you discount that number back to today's value. That's what we're doing in this video. And if a company has positive free cash flow, it makes it a lot easier for them to pay down debt, pay dividends, acquire other businesses, or invest back into their business to grow it. If a company has negative free cash flow, it might not be able to do any of those things unless it takes on more debt. So this company only has positive free cash flow in 2017. The other years are big negatives. Net income is a profit and loss on the income statement. It's revenue minus expenses. And they have negative net income in 3 of the 4 years. The only positive is in 2018. Their revenue is fairly steady. It did drop in 2018, but for the other years it was pretty similar. So they're not really growing. Let's look at their financial statements. In 2016, they had $2.9 billion of revenue, and their operating income was $316 million. The reason the company reported negative net income that year was due to this restructuring of $818 million. Let me show you what that is. Restructuring is one-time costs that companies must pay to reorganize their operations. The idea of restructuring is to make the company more profitable in the future. Examples of restructuring are laying off employees or moving a factory from one location to another. So they had $662 million of restructuring and asset impairments. They also had $68 million of goodwill impairment. The company also expects to have $80 million of charges related to its Series 6 modules. In 2017, they had $2.9 billion of revenue and $215 million of operating income. Their pre-tax income was $202 million. The reason they had negative net income in 2017 was this tax provision of $371 million. Let's look what that is. In 2017, the U.S. government applied a one-time tax penalty to a lot of companies who did business overseas, and this company got hit with a $408 million tax charge. The U.S. government is trying to stop companies from going overseas to avoid paying taxes in the U.S. And in 2019, the company had $3 billion of revenue and $200 million of operating income. The reason they reported negative net income was the $363 million they had to pay to their investors for defrauding them. I mentioned this litigation charge in the first 30 seconds of this video. This is the statement of cash flows. To calculate free cash flow, it's cash flow from operations, which is on the top, minus CapEx. And they have negative free cash flow in 3 of the 4 years. But only in 2018 they have negative operating income. Operating cash flow can be a better indicator of a company's health than net income. The way to calculate operating cash flow, you start with net income and then you add back the non-cash items from the income statement. Then you adjust for working capital. So depreciation is a big non-cash item. So the company doesn't actually pay depreciation, it's just an accounting write-off. So it's good to see the company is operating profitably except in 2018. They need to invest so much into their business and CapEx. That's why it brings down net free cash flow each year. But hopefully the investment in CapEx grows the company in the future. Let's look at a capital structure. $500 million of debt, $5 billion of equity. They pay 5.74% interest on their debt. Only 8% of that capital structure is debt, which means 92% is equity. And the cost of equity is 11.6%. And to calculate cost of equity, we use the capital asset pricing model. and part of the CAPM formula is the beta. The beta is how volatile the stock is relative to the market. They have a beta of 1.21, so the stock moves a little more than the market. And their WACC is 11.12%, which is a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to future cash flows. We estimated 4 years of future free cash flows. We also estimate a terminal value, which is all cash flows past year 4, that's $2.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.2 billion. We divide that by 106 million shares. And we get a calculated stock price of $21. They're trading at $93, so they're trading at a 342% premium. It's a sell according to the model. Simply Wall Street's even lower. They're at $11.79 a share, so they're saying the stock is even more overvalued. Let's see where the stock has been trading the past few years. The stock has been up and down the past few years, but it's at an all-time high, so it looks like it's doing really well during coronavirus. If you invested $100 in First Solar in December 2014, you'd have a little more than $100 as of December 2019. And if you compare that to the S&P 500, the S&P 500 is doing a little better. And if you look at Invesco Solar ETF, that's performing a little worse than First Solar. If you invested $10,000 in this company 10 years ago, you'd have a little more than half your money, $54.53. That's a 45% loss. This company has never paid a dividend and does not plan to pay a dividend in the future. I'm going to show you some risk factors the company mentions in their 10K. Government subsidies are a big part of people getting solar for their homes. When I got solar panels for my home, it cost about $30,000, but I got a tax rebate. So I ended up getting about $10,000 back, so it saved a lot of money, not to mention the amount I saved each month in my electricity bill. But if the government reduces its subsidies, this could really affect companies like this. Another risk with First Solar is that if its customers go bankrupt or are unable to pay their bills, this could affect First Solar's revenue and profit. I know it's really hard for you to forecast these types of things, but it could happen, and if you're able to see it before other investors see it, it could save you a lot of money. Another risk is their equipment fails or their suppliers are unable to keep up with their demand. This company has a lot of important intellectual property, and they can't really avoid other companies stealing it. The only thing they can do is sue those companies. It is possible other companies do similar things as them, and it's not an infringement on their patents. The company is also subject to regulatory oversight and liabilities, so if they were to make a mistake, they could be in a lot of trouble and it would cost them a lot of money. The company has a lot of environmental obligations and liabilities because they have to dispose of hazardous materials, and hazardous materials are subject to extensive laws and regulations. The company's largest shareholder is Lucas Walton, who owns 21% of the company. So this person may have major influence on the company's decisions. Let's look at the financial ratios. The average PE for the market is 17.2, the median is 15.3. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have a negative PE since they have negative net income, so we can't look at PE. The average price of sales is 4.6, and the median is 2.0. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 3.2, so investors are paying $3.20 for $1 of revenue. The average price to book is 4.7, the median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 1.9, so investors are paying $1.90 for $1 book value. Equity is total assets minus total liabilities on the balance sheet. The average interest coverage ratio is 12.6. The median is 3.9. Interest coverage ratio is EBIT over interest expense, so they can easily cover their interest payments. EBIT is earnings before interest and taxes, also called operating income on the income statement. The average ROE is 13%, the median is 12%. ROE is net income over equity. They have a negative ROE since they have negative net income. The average current ratio is 1.8, the median is 1.3. Current ratio is current assets over current liabilities, so they can easily cover their current liabilities. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables due within 12 months. Examples are current debt and accounts payable. The best way to look at ratios to compare them to similar companies, I've done videos on Canadian Solar and Enphase, both in the same industry as First Solar. And if First Solar has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they're worse than PE because they're negative. They do have a better price to sales and price to book than the average. Current ratio is higher than the average. They have a negative ROE, so obviously that's worse. They're by far the lowest in debt of the three companies, which is great. And they have the highest market cap of the three companies. Nobody in this industry pays a dividend. So to summarize, I have the stock trading at a 342% premium. Their ratios look pretty good, but the financials look terrible. Let me know what you think. Give this video a like, subscribe, or comment below. I reply to all comments. Also, if you'd like to do a private Zoom session with me, get a custom valuation, or just support the channel, you can click the link in the description below. Thanks for watching.